Okay, I think that we can start with today's webinar. First of all, I would like to say hello and welcome to Younium Webinar on the subscription metrics for B2B SaaS. We are really happy to have you all with us today and that you took the time to join us and that you all see that this is valuable for you. We really like it, and of course, we are hoping that we will learn something new today. My name is Hervoy, and I'm a demand generation manager here at Younium, and I will be your host for today. Along with me, I have our subscription expert, Erik, who will take the lead in today's presentation. What I'm really also happy about is that Erik will take the lead on it, because he's one of the, and I know that he will not like this what I'm going to say, but he's truly an expert on this matter, and I'm really hoping and looking forward to learn on some things what I also miss about, especially on the usage-based metrics. Erik is based in Stockholm, Sweden, and I heard that it was today minus 17 degrees there. And I'm based in Zagreb, Croatia, and we have all like we know for a fact, and that to share with you that we have the participants from all over all Europe, and this is really nice that we could connect today in this webinar. Okay, before we start, let us just go into a bit of a housekeeping points. The total time of the webinar will be 40 minutes. And don't worry, I mentioned those usage-based metrics, what I'm nagging Erik all the time about. If you miss on something, we are recording the webinar and we will send you the recording once when it is ready. If you would like also to have the presentation, feel free to reach out to Emily, our head of marketing, via email, and we are going to send you the presentation as well. During the webinar, we will have 2 polls, so also to get you engaged in, but don't forget, we have a chat box. So if you have any questions during the webinar or any comment or anything, feel free to use the chat box. That said, we are going to have the Q&A part of the webinar, and that's reserved for the end. And one more thing, using the chat box, we will also send you some articles, blogs, and feel free to have those in and to click on it and to bookmark those and to use it for later. Okay, Erik, stage is yours.
Thanks, Rory. I'm flattered by your kind words. Okay, so just wanted to mention also that this webinar is directed towards B2B and people in that space and for recurring revenue businesses. But feel free to listen in anyway if that does not apply to you. It might find some interesting stuff here. But just to start off laying the foundation here, we're going to talk about the agenda a little bit. We will start off just talking about subscription metrics in general, and use also financial reporting as a reference point to compare to. Then we will dive deeper into a couple of metrics. We will start off with CMRR and MRR, talk a little bit about the difference between them and how we can use them and compare the two. Then we'll continue to lifetime value and look into what we need it for and why it matters. Also net retention, what does it actually tell us and why it is so important. And then we'll talk also about usage metrics and look over a customer story real quick, and then have a Q&A session in the end. So without further ado, I'll get this going. And start a little bit with subscription metrics in general and compare to financial reporting. And I think we all know that financial reporting is something we need to do for compliance and regulation reasons, right? And that's you could say that it's more of like something we see retroactively, how things turned out up until today with the data we have in terms of invoicing and revenue and so forth in financial reporting. While subscription metrics maybe gives us more information about the future, kind of getting an outlook on how things will turn out probably. And this gives us the possibility to more plan and act accordingly, more proactively, and to see kind of like where our business is going. But obviously, most importantly, is that these two types of reporting combined gives us, the best complete pictures, for our stakeholders and management over our business. So with that said, I'll start to dive into maybe two of my favorite metrics, CMRR and MRR. So just to start off with, the concepts here, CMRR is really the contracted monthly recurring revenue. And that basically means that it's something we measure from when we contract the customer, when they sign up for our service and committing to using it at some point, right? While also, the annual equivalent of CMRR is ACV. You could say it is CMRR times 12. You can see here spelled out annual contract value, right? So the CMRR on an annual basis. And that compared to MRR, MRR is, you can say the effective monthly recurring revenue, from the point that they will actually effectively start using and paying for our service, right? And the annual equivalent of that is ARR, annual recurring revenue. But to give you like a more better understanding of this, I'm gonna provide you also with an example here. So let's say that today we are actually contracting a customer, 7th of December. That's great, balloons, serpentines, we're celebrating internally, we're saying, okay, we have a new customer, that's great, right? But maybe they won't actually, effectively start using our service until 1st of January. And let's say also that the monthly price that they will pay is €1,000. So I'm gonna bring out a little table here to like kind of like see how this turns out. So if we look right now in December, we know that we have a contracted monthly recurring revenue of 1,000, and then we can see from here that throughout time the monthly recurring revenue would start at 1,000 in January and look like that throughout the subscription period. So if we also zoom out a little bit and take a look at our whole subscription stack, one very good usage of these two metrics is to compare the two and to analyze why there possibly is a gap between the two. I hope you can see this, but if we look at June here, 2021, we see that we had a CMRR of about €140,000, and we had an MRR of about €120,000 in this example, dummy example here. And then you can realize, okay, there's actually a gap here of about €18,500 between the two. And then we might want to, start trying to analyze this. Why is there a gap here? So gap reasons. One reason is exactly what happened now in our example. There is a delay in the effective start that the customer will start using and paying for our service. And those of you who work in B2B, you all may know that this time of year, for example, there's a very common scenario that you sign a new customer now during December, but they might just basically start using your service and paying for it, beginning of next year, in January, or maybe even they need to close their books, for the previous year. They might want to start in February or even later than that, right? And that can create a gap in between CMRR and MRR, right? Another reason could be ramp-up deals, which also happens in B2B, that maybe for a specific period, maybe like the first half year, they pay maybe €500, and then after that, they would pay €1,000. And in that case, we would see the CMRR as 1,000, because that's what we contract with the customer. They will, throughout time until they cancel the subscription, pay 1,000, while maybe the first half year they pay 500, which our MRR will say those 6 months. And then another example is kind of similar, but maybe that we actually have free of charge periods. That maybe that first half year, those 6 months, it's actually, you know, free of charge. They don't pay anything. It's zero those 6 months, and then after that maybe 1,000. So why do we then use both metrics? Why do we need both? As you may see that there are some similarities with them, as well as differences, right? So this very analysis is one reason, you know, to basically see, okay, and understand our revenue lags. Why do we have revenue lags? What is behind it? And then analyze that according to, you know, what's contracted versus what's effective MRR, right? And then to compare the two, we can say that CMRR is maybe, you know, more for a future outlook. You know, what are we contracting with our customers? What will they actually pay in the end, although we have these gap reasons, right? To kind of see like a trajectory of where our business is going. While MRR might be, you know, better for kind of like an operational understanding, you know, giving us a good indication of how our revenue will actually turn out, which is good for, you know, financial budgeting, for hiring new people or making big investments, etc. And it can also be a very good use in combination with, for example, a cash flow analysis to use it with, you know, okay, sure, the MRR maybe tells us, okay, how the revenue will turn out per month, which is also maybe how we accrue our revenue monthly over time. But, you know, we can have a mix and different kinds of billing periods, maybe billing, you know, annually upfront or quarterly upfront or biannually, and, you know, it can look very different what actually ends up in our cash bank account. So with that said, I think we have a poll now, right, to get you guys engaged a little bit here.
So yeah, as you mentioned, let us see then on the poll, are you currently using CMRR or ACV as metrics? So let us give a few seconds, and also to send out a welcome to everyone who joined us. We had several people joining a few minutes after we started, and also to mention that we are recording the webinar, and we will send you the recording once as it's ready. And we are also sending some links into the chat box, and feel free to also say hi or comment or send any of your cases maybe for Erik to comment on those. Okay, we have the results. And let's end now and also share them. So we have quite a lot of people saying, of course, that's really good. Then 36% of people say no, but we will look into it after this webinar. Maybe Erik, you can give us also a bit of a comment on this results.
Yeah, I mean, it looks like almost half of you are actually measuring, you know, these booking metrics like CMRR and the annual equivalent ACV, which is obviously great. 36 of you don't, so hoping this gives you some insight into this matter, and it might be interesting for you. I see 9% saying it's not relevant, so yeah, for some maybe it actually depends a little bit on how your business looks like.
Okay.
All right, so let's continue. Now we'll talk a little bit about lifetime value. Short is LTV. And I will bring this example with me here. Again, we contract the customer 7th of December, the customer starts using our service 1st of January, and we have a monthly price of €1,000. And let's add some more information to this also that might be on the contract. Let's say that we contract them for 12 months. So the customer is saying, okay, we'll sign up for your service. We'll start using it 12 months initially and then see what happens, right? And also that, you know, we invoice them quarterly upfront. So for example, now when we're in December and contract them, we'll soon probably send out the first invoice, which will be on €3,000, at first, right? For the first invoice for those, a quarter is 3 months, so 1,000 times 3. And at this point, things get a bit interesting because we might have a financial system that's saying, okay, we have 3,000 euros in revenue. That's what the invoice say. That's what we should get into our bank account. That's maybe something that we accrue also. And that's kind of like, okay, well, is that the whole truth? We're saying to the financial system, okay, wait a minute. So we might want to look at this in a different way. If you look at this table I have here, I have added a little column here or row here called total accumulated MRR to see how the MRR accumulates over time. And then you can see here after the first year, we actually have our ACV or also actually our ARR. We could say, right, that the contract is worth 12,000 because they have signed up to use our service for 12 months, paying 1,000 per month, right? So that's kind of like something we want to see that, okay, but that's actually the contract value. But then, we might also ask ourselves, shouldn't this contract be renewed after the first month or the first year? Probably, right? I mean, that's something we need to find out. How long does our subscriptions actually usually last with our customers? And then you can see here that, like, okay, if we continue to look beyond the contracted 12 months, we can start looking at, not what is the committed MRR for those 12 months, but also MRR renewal to see, okay, if we renew this contract after the first initial year here, it will continue, right? And continue to the MRR will continue to accumulate. And then that's where it becomes interesting to look at the lifetime value, which is an estimate of the average revenue that a customer will generate through their lifespan as a customer. And this worth of a customer can then help us determine many good economic decisions for a company, including marketing budgets, resources, profitability, and forecasting, and so on. So let me go over a lot of very complex formulas with you, and we're gonna crunch some numbers. Just kidding, we're not gonna do that. Let's just hop over that, and let's just talk about an example here. So LTV is usually a monetary value for an average lifetime of a subscription, right? And with that, we can also calculate the lifetime value in form of a period also. So let's say for the sake of a very easy example, let's say that our lifetime value of our customer stack is 120,000 euros. And if you know your average revenue per customer, which you also need for calculating your LTV. So if you have your LTV, you probably have your average revenue per customer as well. Let's say it's actually 1,000 euros, kind of like our subscription example that we looked through. And then we can easily calculate that the average customer lifetime is 10 years. So I'm gonna bring forward a table here again. And now we're gonna use the MRR, committed and renewal MRR, to accumulate it for 10 years. Because we're saying, okay, the lifetime, of our customers is on average 10 years. So let's just look at that a little bit there. And okay, what a coincidence here. If we accumulate it, we see that the lifetime value of our subscription example is 120,000 euros. So this might, give you an indication of like why this is important, because, although we should obviously look at the financial reporting, as I said, that's also important, and maybe, the actual current annual contract value or the total contract value, we might want to look at this also and say, what is the probable, value of this customer, or, what's the worth? And 120,000, as you might understand, is a bit different from, now in December, what our financial system is saying of, 3,000 in actual revenue that we should, get to our bank account from the first invoice we sent, right? Okay. So next up, we will also talk a little bit about net retention, which is also, a very important metric. And again, you're probably getting used to this example, but I will continue using it to keep things simple. We've contracted a customer today, start date 1st of January, monthly price 1,000. We know that now. So I'm gonna bring out a table again. These you're probably familiar with now as well. Now I just have the MRR here as one row. Then I've added net retention here as well, which is a percentage. And just, to give us an understanding of what net retention actually means is that, why is it 100 here in January? What does that mean? So net retention is basically how much we retain of the starting value of the customer subscription. So the MRR in the beginning is 1,000, right? And nothing has happened, so it's still 1,000, and then we have retained 100% of the value. If we simulate the future a little bit here and say that our customer is really happy, it's all good, and they want to use your service even more. So from 1st of February, we do an upsell of 500 euros. So basically, your customer will start paying 500 more. That will add to the value. So you see here in February, now our MRR will be 1,500, and 1,500 of 1,000 is 150% of that 1,000. So we've retained 150% of the initial value of this customer subscription. Let's say things go a bit south, or something happens to the customer. They're saying, oh, we can't use your service this much, we want to pay less. So already in March, they're saying, okay, let us pay 250 less. So we end up here in March at a value of 1,250 in MRR, and that would then be 125% retained of the starting initial value of this subscription. So if we say that it goes really south, maybe the customer folds, or they're really unhappy. hopefully not, but they actually churn. We lose them in total. They won't pay anything from April here. So then the MRR is obviously 0, and then the retention is obviously also 0. We have nothing left of the contract value. So let's just also think a little bit about what this means, and kind of think about our whole subscription stack and our retention of all of your customers, right? Let's take this as example of 100%. So let's say we have below 100%, 75%, let's say. Then you can start to think, okay, we're actually stagnating, right? Our customer base is decreasing in value. We're actually losing revenue. So new sales, our sales team basically need to hunt down customers to make up for this gap, because our business is going down. It's decreasing in value. So we need to basically hunt more customers to fill that gap, that 20%, 25% gap, just to keep our revenue at the same, and then they need to hunt even more customers to make us grow, right? So that's really bad. And on the other hand, if we take this 125% as an example, that's great then, because our current customer stack is actually growing. Our current customers gives us a growth, more revenue, and I mean, if we're growing, that's great, and maybe we're not reliant on sales to keep us afloat, right? Sales can just focus on then bringing in new business and making sure that our business is growing even further, except our current subscription stack, right? So just easy summary of this is then that you can maybe figure out that net retention below 100%, bad, right? And then net retention above 100%, that's great, super, well done. And probably our customers are then happy as well. That's also an indication of net retention, right? It's telling you it's different things, also other things. So with that said, I think we have another poll coming here.
I need to admit, you got me a bit with that formula for a second there. Yeah, so let us go into the second poll of today's webinar. And just give me a second that I launch this one. Okay. So how many hours per month does your team spend on the subscription related reporting? And so we have below 2 hours, 2 to 4 hours, 4 to 10 hours, or more than 10 hours. Let us give a bit more second because we have more people joining in during the webinar. And yeah, kind of also interesting to see that we focus the sales on focusing to the new market. That is also very good good info what we would like to have there with the net retention. Okay, a few more votes maybe. No? Okay, let's share this.
Yeah, a couple here.
A couple more. Okay.
All right.
And let's share the results and let Erik comment those. So we have 42% of people saying between 2 to 4 hours. We also have quite a lot, 28%. That's really good. I mean, not good that you spend more hours, but it's 4 to 10 hours on the reporting. And then we have also below 2 hours, 22%. So maybe Erik, you can comment on this.
Yeah, I mean, the 22% of you that has below 22 hours, that's super. Maybe you have your data in order and can streamline this. 2 to 4, I mean, not bad either. Maybe some improvement points. 4 to 10 sounds a little bit rough, you know. Maybe you should do something about it. More than 10 hours, actually 8%. So maybe you should definitely look into that as soon as possible. All right, should we continue? So I think Hervonia has actually sent you some links in the chat about our subscription metrics blog series, and the last one up, part 3, was about usage metrics. So basically, how do we measure variable fees? Are those recurring, and should we measure them as recurring revenue? So I'm gonna I promise last time with this example, but again, 7th of December contracted, starts 1st of January, monthly price of 1,000. We'll add some more information this time as well. Let's say that in our service, there's also a usage fee or consumption fee or whatever you want to call it, variable fee. And it's because our service, you can actually also email from it, let's say. And we have a fee of €1 per email sent per month. Maybe a simple example, but you know, €1 maybe you most of you think it sounds expensive, but just for simplicity. So how do we go about and you know, measure this one as well? If we think we see a recurring pattern of our usage fees, we think that okay, our customers, you know, are always using or something like basically in this case sending emails, then we should maybe consider it as recurring revenue as well. And then we should also measure it as recurring revenue, right? So let's do some more things here. When we sign the customer, maybe we with them estimate their usage. And we're agreeing that, okay, yeah, they're gonna send about 100 emails per month, let's say. And this gives us the ability to actually introduce a new metric called forecasted MRR. So basically, we're forecasting, you know, recurring revenue from this usage estimation. And we basically just take the estimated usage of 100 emails times the price 1, which is 100. And this gives us an interesting, you know, ability to then further iterate. I'm gonna start, you know, showing the table here again. Added some more rows, and the first row you see there that I added is EMRR, estimated monthly recurring revenue. So we basically take the contracted monthly recurring revenue, which we know is 1,000 because we know, well, we have a monthly price of 1,000. That's, you know, what they are going to pay. That's for sure. And then we add the forecasted MRR. So that means that we have 1,000 plus 100 equals the EMRR, which is then 1,100, which is, you know, like significant, right? It's above the CMRR. We should, you know, include this if we see that, you know, if we think this is should be in our recurring reporting. So let's say also that, you know, for now in December when we contract them, we obviously don't know how much they're using because, you know, they haven't started our service yet. But let's say that they start in January and January actually passes. And now we know the actual usage in January to be 90. So then you can see here, we have our regular MRR here that we know and love. But then we also, I've introduced this usage MRR. So then separated from the MRR, we can also look at, okay, you know, the usage MRR according to what they actually used. So then we know that they sent 90 emails times that with the price one, and that's the usage MRR. And then we can add those two together in our reporting and say, okay, the MRR, regular MRR with the usage MRR combined is then 1,090. Let's say now also that February passes, and then they sent 110 emails in February. Let's see how that looks then. So we have a regular MRR, 1,000 still. Then our usage MRR is 110, right? And then the combine is 1,110. And then you'd think, okay, but we've been talking about this, you know, like forecasting the future and seeing how the MRR is going forward and like getting an outlook of the future. So as we know, like the previous, you know, usage in the months that has passed, we can then use that information to then forecast, okay, what do we think is the recurring revenue going forward for these usage fees? So if it's 110 in February, let's say it's going to be 110, then that's probably what they will use. So let's say throughout time that they will keep having 110 in this usage MRR, right? And combined there. All right, so that was the last tricks we were going to look into. I'm just going to give you, before like wrapping this up, I'm going to show you just a customer story. You know, Loop 54, you might understand they're using Younium, right? That's the point. And they're a smart e-commerce personalization technology to boost conversions with unique and responsive customer experiences. I would highlight a couple of things here connected to what we talked about today. First of all, this point here, they have, you know, in their subscription stack, in their pricing model, they have both this like fixed monthly price, you know, that is more easily measurable, plus also a lot of variable fees, user-based fees, and they're being able to, you know, have control over this and get accurate forecasts, you know, with these metrics that we talked about. And then we talked a little bit about, you know, financial reporting versus subscription reporting, and they have a fully integrated flow to their financial system for Knox. That's one of many plug and play connectors we have ourselves that we have built and maintain ourselves. So that's a little bit about Loop 54. And just to wrap things up from my side, you know, just to make sure that you leave with some takeaways, some points to remember. Maybe it was a lot of information to take in, but let's just you know, have some bullet points here. We talked about CMRR and MRR to get both an outlook on our future and, you know, usage for some operational planning, and also the really powerful tool is to compare the two to understand your revenue delays. That is very common in B2B, right? We looked at LTV to basically see, you know, the complete and probable value of our customer subscription instead of just blindly looking at what we have in our financial system in terms of what we retroactively have, you know, invoiced them. And then we looked at net retention and talked about the, you know, big importance of, you know, having growth in your current customer base, just to make sure that there's no need for sales, for new sales to fill up these churn gaps that you might have. And then we talked about the usage metrics, right? And as long as you think that there's a recurring pattern, our customers are consuming something that we also charge them for, make sure to measure your user-based fees as recurring as well. That can give you a good overview, and also, you know, separate the two, the MRR and the usage MRR, give you a good overview of your recurring revenue. Thanks. Q&A time also.
Thank you, Erik, so much for this really, really insightful presentation. I hope that I will not send you messages now on usage-based metrics. Again, really, really good insights, and especially the one where you compare the financial system and how it works with the subscription management system. That was really, really interesting for me to see again. Yeah, so before we deep dive into the Q&A part, let us just give a bit of an intro about Younium and who we are and what we do. So Younium is founded in Sweden in 2017. We currently have offices in Amsterdam, Stockholm, and Malmö. And we are specialized in B2B scenarios. So this is something what we are dealing with and where we are thinking that we can bring the most value. So basically with advanced B2B subscription scenarios, and this is our niche, and you can see some of our customers below. Also, we shared, as Erik mentioned, few of the articles and blogs, what you can check out, and we will be really, really happy if you do so. We will also share you the links to our Knowledge Hub. And please browse around, please see if you find something interesting for you and something useful where you can learn more and explore more on these topics. We will also add on Watch Younium in Action. I saw that Erik used the 7th of December as a good date. So yeah, today is the 7th of December. So we don't need to sign an agreement today, but we can do it in the end of the week. That's a little bit of a joke on my side. Okay. Let us now go into the Q&A part of the webinar. We have a couple of questions. So the first one goes like, if you churn a customer, how long do you churn their revenue for? For example, if you lose an annual customer and you want to work out net retention, do you churn the revenue for just 1 year or for every year onwards?
Yeah, that depends on how you churn the customer. Like obviously, if you churn a customer, you have these, again, two types of metrics. You have the booking metric, CMRR, for example, and you have you know, the subscription metrics, MRR. So if you churn the customer after the full year, well, then they will churn in terms of MRR after the full year. But it also depends on when they actually tell you that they want to churn, right? That's a booking metric. So like, okay, what day do they actually say they want to churn? One other example of MRR, how to measure it, you know, MRR churn is you know, if they cancel and they say we don't want to pay after half of the year, well, then the MRR churns after half of the year.
And how will you treat overages? If contract is volume related for a period, client uses more volume inside period and needs to top up during the year, but their renewal end of year is likely to go back to the previous year contract.
I think I understand the question, but how you treat overage? So, you know, in terms of usage, you might want to measure it in a period, right? That's the whole thing about subscriptions, that it's period based. One common example is that you have a period of a month that you're measuring, and then you know, invoice overages after that month. So in that sense, like, okay, if they should pay like 1,000 per month for, you know, some variable like usage based fee, and maybe you want to invoice that for the full year, right? 12 months, so 12,000 upfront. And then you have, then you know, like, okay, they will pay, you know, up to 1,000 per month, right? But let's say that includes, you know, 1,000 emails or something. If they go above 1,000 emails in that case, then we consider that as overage, as exactly as you say here, and we will invoice for only the overages, right? And that would then be considered as a usage metric, right? That, okay, we have this MRR of 1,000 for this usage-based fees per month, but if they go above that, then we will invoice the overage, and that would be considered as, you know, the usage MRR, basically.
Interesting. And do you have a view on CAC measure?
Yeah, if you're wondering about the Younium system, yes, we have a view on CAC measure. Maybe you're thinking of like how to relate it to LTV, which is a common thing to do. Yes, we have a view on CAC. The only thing, you have a part of the data in Younium, right, with your customers and subscriptions and all that stuff. The only thing you need to get into Younium then is your acquisition costs. So if you get that into Younium, you have a good CAC view in Younium. Yes.
And again, back to the Younium. So connected to the question of integrations, does Younium support connectors, and what type of connectors does it support? In this example, we have HubSpot. Does Younium support connecting to the HubSpot?
Yeah, Younium does have. We have our own plug and play connector to HubSpot that we build and maintain ourselves. In terms of kinds of systems, yeah, we connect to CRMs, financial systems, as we talked about, ERPs, multiple of them. We connect to billing gateways, Stripe, for example, to take payments through credit card, direct debit, invoice gateways for invoicing, for example, also customer success management systems. Yeah.
Does it connect to Xero?
Xero, yeah. So Xero is actually something that we're building right now. So Xero will be a connector we have very soon. Yeah.
Okay, and one more question comes in, and that's connected to what you mentioned, to the financial system and this communication, let's call it, with the subscription management system. Can you tell us a bit more about this interaction between these two systems and how they, let's say, somehow like are matched together? I don't know. Can you
No, I understand the question, and there's really two. I mean, kind of like overall two ways you can do it. So one way is actually you can have your accounts receivable in Younium, and then you send the invoices from Younium, and you do the accruals and revenue recognition and taking the payments, and then you take out journals from Younium and reconciliate that in your financial system. That's one way how we connect to financial systems. The other way is that your accounts receivable remains in your financial system. The invoice, documents, the invoices goes from Younium and posts to your financial system, and then they're sent from there, and you're on your accounts receivable there. So there's kind of these generally two ways to proceed with that.
Great. No more questions, Erik, and thank you so much for sending all of those in the chat box and also in the Q&A part. And to end the webinar, we would like also to say to everyone who joined today, Merry Christmas and Happy New Year to everyone. We hope that 2022 will be really, really good for you all, and that you will use some of these insights for the future, and that you and your businesses grow and that your skills grow as well. Also, feel free to reach out to Erik if you have any cases or any scenarios what you would like to look into. I'm sure that he will be more than glad to answer. He's answering all the time my questions. So feel free to connect with him via LinkedIn or just via email. That's also fine. I'm sure, Erik. No?
Yeah, of course.
Thank you, everyone. As mentioned, we will send you the recording when it is ready. If you would like to have this really cool presentation with that really, really cool formula what Erik shared, feel free to reach out to Emily, and we will send you also the presentation before we send the video. Okay, that's that. Thank you so much, and Merry Christmas and a Happy New Year.
Thank you. Merry Christmas, Happy New Year. Thanks for coming. Bye.